We're going to stay on the theme here, more on KB's second quarter earnings and a look at the bigger trends in housing and mortgage markets. We bring in right now Mahesh Swaminathan. He is the head of residential mortgage strategy at Credit Suisse. Mahesh, we're glad to have you with us this morning. So FHA is raising the loan-to-value ratio for mortgages that can be bought by Fannie and Freddie. What does this acknowledge? What does it permit?
It's a welcome development. The current legislation allows home-to-value ratios of up to 105%, but if it is increased to about 125%, an additional 10% of borrowers would qualify. That translates to around 3 million borrowers who would qualify. However, the actual impact on housing activity will still depend on other factors, such as having the right amount of documentation and the right amount of appraisals, etc. So this is a welcome development, but it's not going to, in itself, be the cure-all.
Mahesh, what did you think about what the Fed did, or rather did not say, this week about its asset purchases?
One thing that stood out was there was absolutely no mention of the mortgage purchase program, MBS purchase program, or anything related to it. We had hoped for some sort of an acknowledgement that there might be a need to mingle the purchase of treasuries and mortgages, and the acknowledgement that the Fed would remain involved in the MBS purchase program. While we do expect them to continue to be there, there was no mention of it, which was a little bit disappointing to us, and we are concerned that if the market perceives that the Fed's support is waning for mortgages, for the mortgage purchase program, it could threaten higher rates.
So let's talk about higher rates. I mean, we have to assume at some level that more people who would have been willing to refinance stay on the sidelines. Is that right?
That is true. Just versus last month to now, the amount of refinancing activity has been cut in roughly half. And this is something that we had been concerned about, and it is playing out. I think the other element to worry about down the line is there have been some signs of turnaround in California. There have been some foreclosure properties that have been selling actively, but it's been driven by lower prices and low mortgage rates. So if mortgage rates go up or stay at where they are now, it would incrementally require even lower prices for that inventory to clear. For every half a percentage point in increase in mortgage rates, you would need roughly a 5% lower price point for the buyer to be interested in it.
Mahesh, so is the answer just more clarity, more communication from the Fed?
Absolutely. There's certainly we need more clarity and an acknowledgement that mortgages are still central to a housing recovery.
All right, and just risks if we get stronger economic data. Obviously, that's good news for the economy, but the flip side is what for the mortgage market?
I think the risk is over the next several weeks and a couple of months, we will probably get stronger economic data. But if it is viewed as declaring victory and mortgage rates are allowed to drift higher, that would potentially derail the recovery down the line.
Mahesh Swaminathan, we thank you very much for joining us, coming to us there from Credit Suisse.